good day, everyone, and welcome to another episode of the Mortgage Chat podcast. And today I have a very special guest, Tuan from Duo Tax, who is a very special mate of mine that I've known since 2015, I think it is. Too long by the sounds of it. And Tuan is known as a market leader in depreciation. And today we're going to talk all things about depreciation. So Tuan, why don't you introduce yourself a little bit and tell our audience what you do?
Yeah, thanks for having me on the show, Tony. I've been working with Tony for quite a number of years, and I was gladly happy to come on to the show because Tony is one of those people that you meet in life that give you a chance when there were no chances available. And someone just wrote a quote this morning, actually, in my team meeting this morning, and they said, "When opportunity doesn't knock, you build the door." And for me, that is really been the case with you. You really were that light for me when things were very hopeless, it seemed, especially in early stages of any business. For anyone that's out there that runs a business or started a business, it's not easy. But for me, as a tax depreciation expert, that's what I wanted myself to be, because I was a property investor many years ago before I started my Duo Tax Quantity Surveying business. I found an accountant that referred me to a depreciation schedule, as most people do. Back in the days anyway. Nowadays we have buyer's agents and property managers and mortgage brokers and that advise on many things. But I was fortunate to meet an accountant that advised on depreciation. And when I got that depreciation schedule, I experienced it for myself. And one, I thought I could replicate that because I saw someone do it for me. But secondly, more important than being able to do it, I think it served a great purpose. I always share the story of a $15,000 tax deduction on this brand new duplex that I had bought back in the days when I was younger. And it added so much value to my life because, when you're earning $60-something thousand a year, as an engineer. Yeah.
What year was that?
That was back in 2010, I believe, or something like that.
Because you were an engineer.
I was an engineer, so I was a construction grad, but went on to become a civil engineer on site work, and I really got into processes and was very driven by meticulous detail. Being on site, you didn't really have any margin of error to work with. So being precise was everything. And for me, I've always had that mindset, which is, I've carried on to my business, and I really, I'm thankful for that experience. But, the depreciation thing, regardless of what you do in life, if you're earning a modest wage and you get a big tax deduction of $15,000, I believe it was, that can really change your sort of outlook on investing.
Correct.
On what are the benefits of even doing it? Because it's from an investor back then, I thought, well, I've just dumped a heap of money on this property. And at 20, I think it was 25 or 26 at the time, I was like, where is this going? Do I really understand it? I wasn't as educated as a lot of people are today, or even like what I know now. Like, I didn't have that education and that knowledge. But so when I get that tax deduction and a refund of $7,000, I thought, well, this is a great way where I can either put it back into an offset account and then maybe build on another property. So that was really powerful for me. That's the power. That's the essence of depreciation. And that's why I thought, here's something that I could do, prepare tax depreciation schedules, because I had the construction background. But then I could actually apply and help other people realize that themselves. And if they can use the power of that bit of negative gearing that the ATO, allows us to legitimately claim, then why not? I couldn't believe how many people didn't know about it.
Yeah, because you can go, your property cash flow wise can be a little bit negative, right? From, after paying your expenses from the property. But that depreciation claim at the end of the financial year can actually push that property back to a positive cash flow.
That's correct. And it's the only tax tool, when I say tax tool, the only tool the ATO approves that allows you to claim a tax deduction that is called a non-cash deduction. And a non-cash deduction is essentially when you have a loss, like rental income is a loss. Well, this is a loss in your property because your property is depreciating, and we as quantity surveyors record the loss.
Right.
And that loss is only on paper. So we say on a piece of paper that says this building is depreciating at $20,000 in the first year that it is built. So you don't have to physically take $20,000, pay for the building, do you? You can finance the home or the house or the rental property and then depreciate that, claim it as a tax deduction on paper. So then what happens is even if your property is in negative position, you could ultimately go from a negative position, but because of your big tax refund from the depreciation of $20,000, here's a slap of $7-8 grand, depending on your tax bracket, that could push you back into a positive cash flow position. So we call it negative geared property with a positive cash flow position.
So can you explain to the first-time investors out there, how does a depreciation report actually work?
Perfect. Yeah, completely. A depreciation schedule is an ATO compliant tax tool, and how it's made up is it needs to be prepared by a suitably qualified persons, and that persons can be a quantity surveyor. And this quantity surveyor is not just an ordinary quantity surveyor, Tony. It needs to be a quantity surveyor that is registered with the Tax Practitioners Board, which is essentially all accountants, right? Tax Practitioners Board, they manage the sort of compliance and making sure that your accountant or your tax agent is registered and has the right insurances in place to make sure they can conduct business. Well, for us as quantity surveyors, the reason why we have to be registered tax agents is because we're advising on depreciation schedule rates. So if you've got a washing machine, there's a certain depreciation rate applied to it because versus, say, for example, carpet. A washing machine is going to depreciate or deteriorate much faster than a bit of carpet because the carpet can wear and tear over a longer period of time. So there's a bit of common sense that's applied to this by the ATO, and they call that the TR 2022. So every year they update the depreciation rates. They will update what is called the tax ruling 2022, as we have now is the latest one, and next year they'll have 2023. And so essentially what we do is then to get a depreciation schedule, we have to go out to the property to assess the property for depreciation. So for certain examples would be an inspection would warrant that us to look at curtains, air conditioning units, lighting in the property, carpets, is it timber floorboards? And then you've got things that we need to look at, for example, is joinery. Like, for example, you might have a tall boy. A tall boy is essentially a piece of furniture that is floating. You could move it around. Versus a built-in. A tall boy would be a piece of plant equipment and would depreciate over potentially 8, 9, 10 years. Do forgive me for not knowing all my depreciation rates. And then you've got a built-in wardrobe, which has a 40-year effective life, which is the same as a structure because the ATO sees that, look, one piece is moving, floating, and can potentially wear and tear much faster than a built-in wardrobe, which is part of the structure of the building because that's been sort of plasterboard in, built into the property. And so these are some of the things that the ATO requires us to do to ensure the compliance of a depreciation schedule. And so you have two classes of assets with the depreciation schedule then. The first one I mentioned was a bit of the pieces of plant equipment. We call that Division 40 as a tax term. And so Division 40 was all your plant equipment, like your range hood, your cooktops, your air conditioning units. Anything that's generally motorized, Tony, is considered plant and equipment. And if you turn the house upside down and it falls down, that's also a piece of plant and equipment. So things like your tables and furniture, your tall boys, they're also plant equipment, even though they're not motorized. So they will consider higher wearing and tearing. And essentially, because of the shorter effective life, and the reason why they have that is because the shorter effective life means you get to depreciate them faster. So if it's motorized and it's only got an effective life of 3 years, well, you're going to get that depreciation back sooner, right? Rather than compared to a piece of plant equipment that might be 10 years. And then you've got the other category of depreciation asset is considered Division 43. And that tax term refers to all structural items within a rental property. And that will be bricks and mortar. So your slab on ground, your walls, whether it's brick wall or a masonry wall, or you've got gyprock lining, then they would also be considered capital works. We call it building depreciation. Your glazing, your roof structure, your timbers, they all make up the construction cost considered Division 43. And they have an effective life rate of 2.5%. So you claim 2.5%, 100 divided by 2.5 gives you 40 years. And so generally all residential properties will depreciate at over 40 years. And so the more when we prepare a tax depreciation schedule, what you'll see is a classification of Division 40 plant and equipment and a classification of Division 43. We'll break up all the plant and equipment assets. So we show different varying rates and different depreciation in year one for those pieces of plant and equipment. And then we push over to then we look over to Division 43, which is all your capital works, which is 2.5% of the total construction costs. Okay, so which is all your bricks and mortar. Now, once we work out all the depreciation on the first year of the plant and equipment, we then lump it together to give you a total Division 40 plant and equipment depreciation, and we tack it on with the 2.5% you're entitled to claim on the building side of the construction. Combine that, it gives you your total depreciation that is allowable as a tax deduction that's provided by a registered quantity surveyor. Right. So that's our job, end of the day, to do the assessment, prepare the schedule in accordance with the ATO, and then break it up to ensure that we can try to maximize the depreciation. Now, why is it important to break up these assets? Well, when you got faster depreciating assets in Division 40 plant and equipment, you want to try to yield as much of the plant and equipment inside Division 40 as because it's faster depreciating, right? And so that's our job, to make sure that we are assessing properly, that we're just not all lumping it into 2.5%. Yeah. Because if you're getting 20%, 30%, 10% on plant equipment, you don't want to be missing those items and pushing them into building works, because you're only going to get 2.5%, which is going to be a bit of a...
Especially we're not keeping the property for long term, right?
Yes.
Look, I'm saying when I say long term, I mean 15, 20 years. But if you're keeping the property for, let's call it 5, 7 years, perfect for you, right?
You've maximized the cash flow deduction that's entitled in the earlier years. So you will see most of the gains of claiming depreciation earlier on if you're claiming all these plant and equipment.
And that's perfect for people that's especially on a high tax bracket. Like you said, right? It reduces the taxable income, and at the end of the financial year, big tax return back.
Exactly, and the high, you're right. And at that time, when I was on that low income bracket, the impact of depreciation was very minimal. Whereas if I was in a higher bracket, at 45 cents to the dollar, so essentially you're getting 45 cents back on, 45% back on most of your depreciation. You're really getting ahead with a higher tax bracket. So regardless of where you are, if you're paying tax, what my general rule is, if you're paying tax in Australia and you've got a rental property, it's a no-brainer to get a depreciation schedule, albeit always check first to make sure that there is some depreciation left. Okay. And that's something we do as part of the service anyway, because it costs you nothing.
So Tuan, with current interest rates, we've seen 12 interest rate rises so far in the last 13 months. Okay, it's hurting a lot of people, especially investors. Okay, so how can a depreciation schedule help investors in the market right now?
And I guess funnily you say that, because right now I think we're finding that when the market is great, the response from advisors and professionals out there is that I don't need a depreciation schedule for my customer or my client because these properties are selling. They're selling through the door without any trouble. But essentially, now that the market has shifted a bit, the need for, convincing and the way we market properties is going back to where I remember it used to be when I sort of first invested in property, when the market sentiment wasn't huge, but it was somewhat there. And so we're kind of in that place now where there's not a lot of stock, there's not a lot of turnover in the economy with real estate. Is that the conversations we're having with people now and as professionals like developers is that depreciation is one of those things that are important. And I think I mean, that's all theoretical and my sort of assumption, but what I see in the market, and it's a bit biased, but what I think is happening is that, if interest rates are super high, how can people offset these big losses on their property? And when we go back to building cash flow, and essentially any dollar we can pull back is going to help us, because essentially, if people are buying property and the yields are 5%, 6% if you're lucky these days, and rates are sitting around the same or if not more for an investment loan, you'd be best to know, well, they're going to be slightly in a negative position.
Correct.
And so if you're slightly in a negative position and you think about what's available, then depreciation is one of those things that are a no-brainer because, say for example, end of the year, you're at a loss of $10,000.
Yep.
Yes, when you're negative geared at $10,000. So after considering all your property management fees and holding fees of that property, including interest, if it's minus $10,000, you're looking at getting a tax refund of maybe $3,000-$4,000.
Yep.
Was that safe to say?
Yeah, it depends on the tax bracket.
Yeah, so you get four. So you could still be out by $6,000 out of pocket. Now, if we can get a depreciation schedule that's showing, maybe $10,000, a little bit more conservative than your 20,000 brand new properties. If you buy a property that's 5 years old or 10 years old, you could be eligible for a $10,000 tax deduction, depreciation per annum, right? And so if you can get that, you're going to look at potentially $3,000 or $4,000 as an additional refund.
Wow.
So, $10,000 tax deduction on your 10-year-old home, $4,000 refund. So really now you're only out of pocket $2,000. It significantly changes the impact of your cash flow and your investing sort of mindset, and whether is it even tangible or worthwhile, feasible to keep going down this path. And so the way I also like to look at it is break it down into weeks. If you look at a $10,000 tax deduction, and you're going to get $4,000 out of that tax deduction, that's about $80 a week additional in your pocket. In your pocket for the depreciation. And I believe there is some form that you can fill out with your accountant as well. So actually prepay
Correct.
the tax depreciation.
Tax
I've
variation.
never done it myself.
It's called a tax variation. Yeah.
So you can do a tax variation and you could actually essentially get that money up front in your pay packet.
That's right.
Right? As a pre-tax, as a post-tax tax deduction, is that right? I can't remember. But you will get a tax deduction essentially up front. And if you're in the position of wanting to work with cash flow on a weekly, monthly basis, depending on your pay, maybe consider one of these options.
100%. You just touched a bit on stock is low right now. Okay, so you'll know that because you're very investor based and you're doing reports all around Australia. Yeah. So now, would you say the consumers asking for these reports has dropped significantly for the last 12 months in comparison to, let's call it end of 2020 after COVID to end of 2021 when it was peak?
Yeah, good question. I think generally based on, the only way we can tell is based on the sentiment of our business and the partners that are associated with our business. And if the partners associated with our business are seeing a slight decline, we are growing as a business, but if we look at each individual partner as on average, we found that certain businesses, or more than a majority of businesses, would be now on a decline of the amount of people requesting for depreciation. So essentially there's a lot less buyers out there that are investors seeking for depreciation schedules, and essentially that must mean that there are a lot less investors active in the market. And so that, I think that has a huge deal to a huge bit of to play that comes down to the sentiment in the market. I would say, but I'm not a real estate expert. It's just something that I can sort of depict from my business and the partners associated.
Because you're heavy investor base, right? Your clients in a way,
correct?
Right, so you sort of have an overview of, hey, do you have more people buying these schedules? If they buy these schedules, that means they buy more investment properties.
That's right.
So you'll probably have better insight than most of us.
Yeah, and it is a case of less people in the market buying compared to 2 years ago. But essentially, what you'll find is there is a bit of a lag with our business in terms of people requesting for depreciation. Not everybody gets them up front.
Right.
And so there is a little bit of a lag. And so we do see it now that there is, in terms of the amount of settlements happening now compared to what they were.
Because if they buy a property today, which is the start of the financial year, they probably don't have to get the report till like May.
Correct.
Next year.
Yeah, and that's probably another good point for depreciation is that you don't need to get the depreciation schedule straight away. You can delay it like a lot of people do, and they wait for the tax return period. So you can buy a property in January 2023, and then come to see a quantity survey in probably July 2023, because that's when you see your accountant or whatnot and organize it. And then some people, as you probably are aware, they don't do their tax returns for years, and then you get a referral for depreciation schedule maybe years later. So and so that's always a thing with that's in the market. But you'll find that people do advance on their tax returns, especially when things get tough. We are noticing people are a little bit more sensitive about pricing because of the sentiment in the market and then interest rates having an impact on, I guess, at that level.
So Tuan, I know the tax depreciation schedule, it changed a fair bit the last few years on what you can claim back and what you can't claim back. Okay. So can you tell me the difference between what I can claim if I was to buy investment property today, existing property I buy today, in comparison to buying a brand new property today? Right. So can you elaborate a bit more on that for me?
So the situation back in May 2017 was the ATO made some legislation changes in that back then you could buy a property that was built in the 1960s and nothing was changed. And you bought it in the year 2015, for example. You could claim all the depreciation on all the plant equipment inside that 1960s building.
Right, so if the oven was built in 1960, I can claim it back.
You can claim the carpet, the oven, the chandeliers. You don't see many of those these days. You could claim all that, albeit at a very low cost, of course, even at $500 or $1,000 or $2,000, whatever it might be valued at, but a very low cost compared to a brand new asset. You could claim all that. And when it's less than $1,000, there's accelerated depreciation on plant and equipment.
Right.
And under $300, it's a complete write-off. You can write off a $300 asset.
In one hit.
If you've got one chair in this property, that's valued less than $300, you could write it off there and then immediately in that financial year as a tax, rather than waiting for 5 years because chairs are depreciating a little bit slower. So that was one of the advantages. And so now, when they changed that rule in 2017, they said no longer can you claim plant equipment assets as a depreciable item in your rental property, residential rental property, after May 2017. So effective of May 2017, if you exchanged on a property after that date, so today, you would not be eligible to claim any plant equipment on a residential property that's secondhand.
Right. Okay,
so the property is built, purchased a month ago by someone else, and you buy it a month later. That's secondhand. That's considered existing property. And so all that good depreciation that would have been claimable is no longer a case. So you would have to then claim only the capital works. The capital works being Division 43, building.
Okay.
With the fortunate part is for investors is that the building component makes up about 80 to 90% of the construction cost. As you can appreciate, putting a slab together, roof, tiles, walls, they all cost a significant amount versus putting plant equipment, which is your oven, range hood, air cons and whatnot.
Okay, so let me give you an example. I bought a property this week. Okay. It's a brand new home and I'm using it as an owner occupier. I lived in it for 3 months, and after the 3 months, I'm going to revert it to an investment property. What can I claim?
Good point. Good question. And that is another case where it is considered a second-hand property because the property is now second-hand in nature because you've used it. The ATO sees it as you've purchased a brand new, you've enjoyed the use of this brand new property. You've obviously used the oven, range hood, what have you. Even for a period of a day, 2 days, doesn't matter. Because the intent was to owner occupy the property, you will no longer then be able to claim depreciation on plant and equipment after you decide to change your mind and switch it to investment.
Okay, cool. So let's talk about what you can claim back on the depreciation schedule. So is the claimables on a depreciation report on a fixed price, on a fixed value over a certain year, or is it a diminishing value over a certain lifetime?
So there are two methods of depreciation: diminishing value and prime cost method. The diminishing value has your aggressive methods of depreciation. So less than $1,000, you could aggressively depreciate an oven $900 based on a formula that ATO's provided. There's also then the $300 write-off. You could aggressively write off the asset in that year. And that is the essence of the diminishing value method. The prime cost method, though, has a much more linear. So if you put the the graphs of the diminishing value versus the prime cost method on the same depreciation of a property stacked over each other, you'll find that the prime cost delays the depreciation further along in the later years. So it delays the depreciation for you to claim at a later stage. It doesn't stop it, it just delays it. So you do get depreciation, but just not as much in the earlier years. And so diminishing value is what a majority of investors I find claim. However, the prime cost method is there. And the reason why I find people do use the prime cost method is because they might want to delay the gratification of claiming depreciation, especially in what circumstance. I could safely assume maybe someone's on maternity leave.
I'll give an example, right? Like a heavy hitter like you, right? That's going to get a big pay rise. Right? Is that when you will claim what you just said? Delay the claimables.
So someone who's early on their career, like myself, as you say,
like yourself, right? Heavy hitter.
As early as myself, then I would delay the depreciation claim because it means that I can claim more, get more as a refund because I've got a higher tax bracket at a later. So you're delaying the process of claiming depreciation because you're going to get a bulk of the depreciation throughout an even number of years.
Because there's no point claiming 10 grand when you're on 60 grand.
Correct.
Right? You might as well claim that 10 grand when you're on 100 grand.
As much as it seems appealing at the time, but if you know for sure that you're gonna be on a much higher income in 2, 3, 4 years, I would suggest to delay the process because it's gonna give you better benefits later on. And especially if you're on maternity leave or extended maternity leave and you're not making any income at all.
Or doing what? Or even high comms.
Yes.
Right? Even high commission pays. Right?
Exactly.
Job. Okay, cool. Now, Tuan, we get a lot of customers asking, hey, is it worth getting a depreciation schedule if the house is very old? So let's, for example, is it worth getting a depreciation schedule if the house is, let's say, built in the 1960s with no renovations?
Okay. Essentially now, based on the legislation change of 2017, if you've got a property built in the 1960s, there is no point in getting depreciation because the capital work legislation is still in place. So we know for sure, because you bought a property today, I explained earlier that you can't claim any depreciation on plant and equipment. We know that for sure. Now, the capital work side has its own legislation. And for for depreciation claim on building, capital works, we call it, building depreciation, that has a cutoff period as well. So the cutoff period is the 17th of September 1987. So if you bought a property that's built after 1987, you're safely eligible to claim some depreciation. Not a whole lot in 1987, but of course, as the newer the property gets, the more depreciation you claim, like all things, right? So there's always more aggressive depreciation on a brand new property. So essentially, if you've got a property that's built in the 1960s, 70s, or any time before 1987, and it's completely unrenovated, I would highly suggest against claiming depreciation because there will be nothing to claim. And so what it comes down to is assessment of renovations. Have there been improvements? And to the naked eye or to the common person looking at it, it may not seem like that. But if you've got a property that's wearing and tearing aggressively, and you can't really tell if it's a bit questionable whether the depreciation is in place and any renovations have been undertaken, well, I essentially would highly recommend talking to a quantity surveyor and saying, hey, does this seem like it's worth claiming? Because end of the day, a quantity surveyor is required or expected from the ATO to make an assessment as to what is fair market and what is a fair and reasonable determination of what is a renovation or even the cost, a construction date of the building. So, of course, there's certain limiting factors as to where we can find the build date of a certain property. And if your property is borderline 1988 or 1990, well, we would have to make an assessment by reviewing the property and saying, okay, there isn't the documentation in place. The DAs aren't in place from council to find out when that property was built. We need to make a determination whether it's built in 1988 or 1985.
Right, so you'll make an assessment for the clients.
Correct, including any renovations. And you can claim renovations that are completed on your property prior to you purchasing the property. So if you bought a property that's been renovated back in 1995, you're also entitled to claim that that, regardless of whether you put it in or not.
Okay. So let me ask you a question. This brings me to my next question now. Let's say I bought a property today. Okay, I got a depreciation schedule. Okay. And in 12 months' time, I renovated the kitchen, the bathroom, whatever you want to call it.
Yep.
What happens there?
Yep.
If I want to claim those items back?
Yes. So if if you haven't got a depreciation schedule, then and you've done some renovations, it's worthwhile to keep the receipts on hand. And anything that's to do with the development or the renovation of that, the improvement of that property, and then submit it to a quantity surveyor or an accountant. If it's easily enough for an accountant to look at 100 receipts, or if you've got a simple building contract that you can provide to a quantity surveyor, they can then go into the project and say, okay, well, here's a building contract for $100,000. Well, the job of the quantity surveyor is now to work out what is allocated towards plant and equipment in that 100,000 and what is allocated towards capital works. Now, if we allow all of it as capital works in the 100,000, we're going to shortchange ourselves because we're only going to be claiming $2,500 a year. But if we get as much depreciation on plant and equipment, we're going to be getting probably $2,000 on the $80,000, and then we might be getting another $2,000 or $3,000 on the plant equipment in the first year. So now you've got a $5,000 tax depreciation schedule in the first year versus what would have been only $2,500 if you just lumped it together, gave it to the accountant, and he goes, well, it's $100,000. I'm going to assume it's all capital works, 2.5%.
Yep.
So there's some of the advantage that you can have when you have a quantity surveyor appointed.
But can you make amendments to an existing report?
You can. You can if you've got a depreciation schedule already. It's a matter of just adding on plant and equipment on the installed date, and then that will update the total schedule for the respective year that you're at. Right. That can be done. Also worth mentioning that sometimes when you delete things from the depreciation schedule, for example, if you've got an oven and you've been renting out this property and you've got an oven in there, and you now decide to, you know what, I'm going to rip the oven out. Yep. And there's a residual value of $450. Yep. Well, because you've removed the oven, you're entitled to claim an immediate write-off, a scrap value, we call it, of that oven. So the scrap value of $450 plus the microwave, plus the fridge, plus all the other things that you could add in there, that would then push up some of that scrap value in that year, including if you scrap a depreciable joint, if you scrap depreciable joinery that forms part of the kitchen, that was still it was still under legislation. Essentially built after 1992, which is the cutoff for renovations. If you scrap the kitchen, the bathroom, and there's a residual value of say $15,000, you could claim that scrap value in that respective year.
One hit.
In one hit. Correct.
Wow.
Because you no longer have that part of the depreciating asset, which is the house or the investment property. So you're entitled to claim scrap value on the immediate
So essentially I can claim the scrap value of 15 plus whatever my
depreciation.
So it could be whatever, let's call it 20, 25 grand.
Correct.
Whatever you want to call it.
On the reinstalled kitchen and bathroom.
That's crazy.
Which is brand new. So you get a new depreciation schedule. You have a scrap report that shows here's what's been pulled out of the property that is still technically depreciating as part of the ATO's legislation. Claim those two. But the one thing I want to go back to is if you do scrap it, it means that it makes it a little bit trickier to amend the depreciation schedule, because then your depreciation schedule will have to always consider to delete the old oven or range hood to make sure that we're compliant with the ATO, because we don't want to double dip, claim the scrap value, continue to claim the old plant equipment, and also claim new depreciation. So
man, a few little nuggets right there, Tuan.
There are a few things to consider when we're claiming depreciation for sure.
So now this is a little bit outside the box question. Okay. You're doing depreciation schedules all around Australia. Now, for our investors out there, which states are you doing majority of your reports at? Yeah,
safe to say that these days there's been a big shift to Perth, WA.
Yep.
We still get a very consistent number of people investing in Brisbane. It's always been the case, and I don't think that's going to change.
Okay. So you say Brisbane has always been consistent year on year on year on year.
Correct.
But Perth itself has increased significantly.
Yeah, we found a significant number of investors really driving towards the sort of WA. And, the people that we've been working closely with, that we do refer a bit of business to from time to time, we find that they're much active in seeking in Perth, and there has been a touch of Adelaide that's been very prominent as well. From an affordable standpoint, Adelaide seems to have been very popular, but Perth is one of those things. It's got a very unique lifestyle, I think, and people generally veering towards that for what it has to offer.
So for your investors out there, listen to this guy.
That's
okay.
it.
So what
stats don't lie.
So what about New South Wales? Has it been a big
there always has been a number of people, because generally because our office is Sydney based, it's always been a prominent part of our portfolio in looking after clients that have Sydney properties. However, it is something that is slowly shifting. It is a very slow shift, but it is slowly shifting elsewhere, and I think it comes with the affordability issue, but also the confidence. People are now much more available to access information that's online, and forums and Facebook groups. They're very powerful part of the piece when it comes to investing, and the more confident they are with the information they have and not being spruiked property at property seminars by the wrong people, well, it means that they're making better informed decisions, and so they're more comfortable to use buyer's agents. They're more comfortable to buy themselves interstate. And that's something that growing up for me was not very common.
Are you doing a lot of reports for existing properties or newly built properties? Like, let's call it townhouse, house and land, apartments.
There's a good mix. I think there's always going to be the new properties are always limiting, because the amount of stock available is always, the developers, I think, are not as prominent as they used to be, because of it's harder to build these days, and the cost of building has gone up as well. Not to mention the interest rates, but that means there's always been a shift, and it's always very balanced. The new property segment for us is very small compared to existing, and existing stock seems to turn over much more frequently, and it is a majority of the market as well. But what we do find is commercial.
That's what I was going to ask you next.
Commercial, ever since I started the business, almost 10 years ago now.
10 years?
10 years.
Because we started
8 years now I've been running the business, but we're going into our 9th year. And we find that now the number of commercial investors has gone from 2.5% to 5%.
Wow.
So it's doubled the amount of people that are confident in investing in commercial.
But are they purchased recently or purchased
just within the last 12 months?
Okay.
Yeah, and so, looking at our portfolio, 5 out of every 100 buy commercial property, versus back then only 2.5 people, 2 to 3 people.
Because when did you start doing commercial depreciation schedules?
From the get-go. We were doing it from the get-go, not as prominently, but now that I think there's more conversations about commercial property,
there is.
And people understanding. I myself love commercial. I really appreciate commercial for what it offers. And it's got some really good perks there. And if you understand it, and some of the protection measures that are in place for the landlord as well as the tenants, I think it's a great place to invest, especially long-term contracts, things like that.
Is it the same ruling for claimables with commercial and residential?
Great point. And that's another benefit, is depreciation on commercial property is completely exempt from that 2017 legislation. Right. So that 1960 rule example that I used earlier, you could have a 1960s built run down commercial office or car yard, and you could claim every bit of plant equipment in there that's bought. And the thing about commercial is very complex, and I like to use my example as one. In our office, we have a office that we've bought that is under our family trust. And
am I under that trust?
Yeah, mate. I think you're one of the top beneficiaries up there. Yeah. I love it, man. There's a waiting list for that one too. You can have a bit of the loan that I have there. Just leverage to about 98%.
On your will, all I want is the equity.
All right, man. You're a simple guy, Tony. I love it.
Man.
That's how we were friends for this long. I love it. It's fantastic. But yeah, the benefit of that is buying in a family trust, a commercial property has its advantages, and then now having a trust, and which of course this is not advice. This is advice I was given, and I ended up buying that property in a trust and then rented it out to the business. And there's obviously an advantage to that where you have some depreciation on the building in the trust because it owns the building, but the fit out you complete in the company is depreciable. And when you do depreciation on the fit out, because it's for business use, and there's been a lot of in the past, I would say almost 10 years, they've had those small business write-offs available, which was started at 20K and now built up to unlimited during COVID. And I think it's now going back to the 20K or 30K. Do correct me if I'm wrong, audience. But essentially what that means is that if you're buying assets for business purposes, such as a fit out, and you're using that microwave for staffing and you could claim an immediate write-off on those assets without claiming depreciation at a slow rate. And so that's one of the advantages. And obviously there's other tax benefits that are available, which I won't go into, and that's something you talk to an accountant about. Essentially they're the huge benefit. And when you're a landlord owning an investment property, if the tenant decides to scrap the tenant decides to leave the premises, and not make good meaning you bring the condition of the rental property or that commercial property back to where it was before when you started. So they come in, they take up a lease, they do a fit out, the tenant does a fit out. Now, if they leave that fit out and exit the lease or finish the lease and don't take that or make good, that fit out and the residual value of that fit out belongs to the landlord.
Right.
And that's the ATO allows the landlord to continue the depreciation of that fit out, or if they decide to demolish it, claim an immediate scrap value.
That's good.
And then the new fit out, or new tenant that comes in is entitled to then start a new fit out again.
Right.
So that's one of the things that the advantages of being a landlord in a commercial space.
So that's perfect for people that's buying something run down, right? As is.
Has an existing fit out.
Has an existing fit out. And I go, hey, do you know what? I'm going to strip it out. I'm going to claim it on that. And whatever I'm going to build newly into that property, I can claim that back as well.
100%.
Mate, that's perfect.
Yeah, it's right. and they're some of the perks, and of course commercial has the stigma of long-term vacancies and whatnot, and I think there's things there's ways that it can be mitigated, and so I think that's becoming more popular because of the understanding and the knowledge gap that has been closed now with the amount of information available online.
100%.
Yeah.
So Tuan, for people that don't know what you do out there in the market, okay, because they're using other companies that they shouldn't be using, how can they find you?
They can feel free to reach out to me at Tuan, Tuan, at duotax.com.au. Hopefully you plug that name in. It's not the easiest name, I know. So yes, we're a quantity surveying firm, and all we do is specialize in tax depreciation. We've also help out with valuation, property valuation, and anything property services related we can do. But depreciation is sort of our go-to and our area of expertise. So happy to help. And if you have a property and you're sort of like, I'm not sure if we can claim depreciation, I'm not sure what the fit out's worth that we can scrap, I'm not sure, well, ask the quantity surveyor. It costs you nothing to ask. So always here to help. So Tuan at duotax.com.
Legend. Thanks everyone, and thanks for listening, and I hope to see you on our next podcast.